Friends, now we are going to learn a very important chapter, partnership accounts. Illustration. Illustration for what? That's what I did now. Let's do one more illustration. I'm going to give you a situation. We are going to try that. Find interest on capital at the rate of 12% from the following. Let us take it for two partners, X. Okay. 1st April 20, 1 lakh. 1st October 20, additional capital 40,000. 1st January 21, additional capital 30,000. 1st March 21, drawings 50,000. For X, let's calculate interest on capital. 12% is the rate. For Y, let us take an example like this. 1st April 20, opening capital is 50,000. On 1st September 20, additional capital 20,000. On 1st November 20, drawing 5,000. 1st February 21, additional capital 15,000. If this is the example, how to calculate interest on capital for X as well as Y? I told you it is better to follow product method, is it not? So, multiply by number of months. 1st April, number of months 12 lakhs. 1st October to 31st March, 6 months. So 40 into 6 is 2,40,000. 1st January to 31st March is 3 months. That is 90,000. 30,000 into 3, 90,000. 1st March to 31st March is 1 month. So it will be minus 50,000. So what is the sum of the product? 12 lakh plus 240 is 1440 plus 90 is 1530. 1530 minus 50 is 1480. 14 lakh 80,000 is the sum of the product. So what is interest on capital in that case? It is equal to 14 lakh 80,000 into rate is 12% multiply by 1 by 12, that will be equal to rupees 14,800. That is the interest on capital for Mr. X. So 1 lakh is there from April to March, 40,000 from October to March, 30,000 from January to March, and 50,000 minus is for 1 month. Multiply, get the product, find the sum, apply the rate, you will get the answer. That is interest on capital for X, 14,800. What about Y? 1st April to 31st March, 12 months, that is 6 lakhs. 1st September to 31st March will be 7 months. So that is 70,000 into 7 is 4 lakh 90. 1st November to 31st March is 5 months. So it is minus 25,000. Minus 25,000. Let me do it correctly, friends. minus 25,000, then 15,000 for how many months? 2 months, February to March, 2 months, that is 30,000 rupees. So what is the total? 6 lakh plus 4 lakh 90, 10 lakh 90, 10 lakh 90 plus 30 is 11 lakh 20, 11 lakh 20 minus 25 is 10 lakh 95,000. So therefore, the sum of the product for Y will be 10 lakh 95,000. Hence, interest on capital is equal to 10 lakh 95,000 into 12% into 1 by 12, that is equal to rupees 10,950. Hope it's clear, friends. I just taken an example of two partners in a firm. They have drawn money, they have also added additional capital, and different dates, different amounts are given. I followed the product method to get the interest on capital. So is it clear? Yes, we'll go to the next one. So friends, we will learn how to calculate interest on drawings. What is interest on drawing? Suppose a partner draws money regularly from the firm in which he is a partner. He is withdrawing money from the business for his personal purpose. So that much of money is not available for the business. Therefore, for the money withdrawn by him or by her, he is bound to pay interest on drawing, provided it is mentioned in the partnership deed. Otherwise, it is not automatic. So we have to see whether it is provided in the partnership deed. Yes. Then we have to calculate interest on drawings for a partner. How to calculate interest on drawing? Very much similar to how you calculate interest on capital. Same formula. Drawings into rate into number of months by 12 or number of days by 365, whichever way you want, you can calculate. So the formula for interest on drawings. Drawings into rate into 1 by 12, that is a formula to calculate interest on drawings. Very simple formula, similar to how do you calculate for interest on capital. Suppose let us take an example of a partner withdrawing money from business for his personal purpose in this manner. 1st May 20, 2,000 rupees. 31st July 20, 10,000 rupees. 1st October 20, 7,000 rupees. 1st December 20, 5,000 rupees. These are the monies drawn by the partner. Even for interest on drawing, you can calculate it by product method or by individual method, your choice. So I am going to do product method for interest on drawings also. Now what we should do? We have to calculate the number of months. This is the amount. This is the number of months. How to calculate number of months? From the date of drawing to the closing date. The money 2,000 is drawn on 1st May. We are closing accounts on 31st March. So how many months is there from May to March? 11 months. So multiply, you'll get the product as 22,000. On 31st July, he has drawn 10,000. So how many months from 31st July to 31st March? July is over, August, September, October, November, December, and then 3 months, 8 months. So total 8 months, it will be 80,000 rupees. Again on 1st October, he has drawn 7,000. So October to March will be 6 months. That is 42,000. On 1st December, he has drawn 5,000. So December to March, 4 months. So that will be equal to 20,000 rupees. Now find the sum of the product. 22 plus 80, 102, 102 plus 40, 142, 144. It is 1,64,000. That is the sum of the product. Now let us calculate the interest on drawings. Suppose interest on drawing is 12%. For sake of convenience, what is the answer? It will be 1,64,000 is equal into 12% into 1 by 12. That will be how much? It will be rupees 16,400. Sorry, not 16, it is 1,640. It will be 1,640, not 16,400. Okay. So 1,64,000 into 12% 1 by 12 will be 1,640. So based on the date and the amount of drawing, you calculate number of months, multiply, get the product, find the sum of the product, then on the sum you apply the rate and divide by 12, you will get the interest on drawing for the particular person. What is the entry we have to make? Interest on drawing will be credited in the P&L appropriation account and debited to the partner's current account or capital account as the case may be. So debit capital account or current account, credit P&L appropriation account. That will be the accounting treatment for interest on drawings. So whether it is interest on capital or interest on drawings, the calculation part is very simple. Multiply the amount of capital drawings by the rate and divide by 12. You will get the amount of interest on drawings simply. But friends, here I have taken a partner has drawn different amounts on different dates. He has not drawn it in any particular frequency and the amount drawn is also not same always. But normally you know what happens. Whether you are a partner in a firm and otherwise, you need some regular amount for your domestic purposes. So the partners may decide that they will draw a fixed sum in a certain periodicity. So in that case, how to calculate the interest on drawings? Suppose a partner draws 10,000 rupees every month beginning. Another partner draws 10,000 every month end. Third partner draws 10,000 every month middle. Same amount should be drawn in the same periodicity for all the 12 months. Now the amount is constant, the rate is constant, the division of 12 is also constant. So what is different is the number of months only will be different. So therefore, if same amount is drawn every month in a certain periodicity, either beginning of the month or middle of the month or end of the month, it is easy to calculate interest on drawing rather than following the product method. A certain formula is there to calculate the interest on drawings. I will show you how. So you write, if fixed amount is drawn every month on same day. If fixed sum is drawn every month on the same day. How to calculate the interest on drawing? A. Beginning of every month, first of every month. Suppose the amount of drawing is 10,000 rupees a month, then it will be 10,000 into 12. So the total money drawn is 1,20,000 into, you apply the rate, whatever the rate. Suppose it is 8%. Then you have to multiply by number of months, is it not? If same amount is drawn at the beginning of every month, the number of months will be 6.5 divided by 12. The amount drawn is 10,000 per month, multiply by 12, 1,20,000. Total drawing, 8% is the rate of interest. On that you apply 6.5 months. If it is drawn at the beginning of every month. So what will be the answer for this? You have to calculate and see 10,000 into 12 into 8% into 6 by 6.5. What will be the answer? You have to find out. Let's find out. So you can cancel 12 and 12. So it will be 800 into 6.5. That is 4,000 or it is 5,200 will be the answer, I believe. 100 in 10,000 8% is 800, is it not? So it will be 800 into 6.5. Whatever the number, that will be the answer. So I think it will be 5,200. That will be the interest on drawings. So if same amount is drawn on the same day every month, and if that happens to be the beginning of every month, that is first of every month, very, very easy to calculate interest on drawing. First to find the total drawing, then multiply by the rate, multiply by number of months, divide by 12. The number of months should be taken as 6.5 months. Very simple. Suppose on the contrary, the same amount is drawn at the end of every month. The only change will be the number of months. In the place of 6.5, we should put it as 5.5. Easy. So the calculation will be 10,000 into 12, that is total drawing of 1,80,000 into 8% into 5.5 by 12, which will be equal to 800 into 5.5, that is equal to rupees 4,400. So where is the difference? The difference is when it is drawn. If it is drawn beginning of every month, number of months is 6.5. End of every month, number of months is 5.5. So automatically the amount of interest will change. Suppose it is drawn middle of every month. Mid of every month. Then also the calculation is very simple. 10,000 into 12, total drawing for the year, multiply by 8%, number of months will be 6 divided by 12. So opening date 6.5 months, middle 6 months, end 5.5. Easy to remember. Same amount drawn, beginning of every month, apply 6.5 months interest. Middle of every month, 6 months. End of every month, 5.5 months. So what will be the answer? It will be 800 into 6. That is equal to rupees 4,800. But friends, please remember when we should apply this formula. We should apply this formula only when a fixed sum is drawn every month on the same day. Whereas on different dates, different amounts are drawn. It is better to go by the product method to calculate the interest on drawings. So whether it is interest on capital or interest on drawings, it is advisable to calculate that by product method. But if it pertains to interest on drawing, same amount drawn every day, same month, see is it beginning of every month or end of every month or middle of every month. Accordingly, you apply interest for 6.5 months or 6 months or 5.5 months. You can easily calculate the interest using this formula. Okay, friends? Let's now go to the next one. This is another important point we have to learn relating to partnership accounts. Guarantee of minimum profit. What is the meaning of this? See, you know, in a partnership firm, all the partners are supposed to share their profit on the basis of the profit sharing ratio as per the agreement. But sometimes a partner may be admitted newly. The other partner may guarantee, okay, we will give you 1 lakh of profit, whatever be the profit of the business or not. Minimum we will give you 1 lakh. Like that, the partners, other partners may guarantee an incoming partner with a minimum profit. Why they are doing it? They want to retain that partner. That partner may have good knowledge in the business or it is young and enterprising. So they want to retain that partner. So they say, whatever be the profit or loss of the business, we will give you 1 lakh per annum. This is called guarantee of minimum profit. So the person who is guaranteed the minimum profit is certain that whether the firm makes a profit or loss, he will get minimum of 1 lakh as a share of profit, so that he will be interested in continuing in the business. If such a guarantee is given to a particular partner, how to calculate the profit share available to all the partners, including the guaranteed partner, and how it should be accounted. That's what we have to learn here. Okay. Now let's take a simple example to understand this. Suppose, let us assume X and Y are partners sharing profits in the ratio of 3:2. Z is admitted for 1/5 share. Assume Z is given 1/5 share with a minimum guarantee of rupees 1 lakh. Now, how the profits will be shared by the partners? After Z has joined, what is the profit made by the firm? We have to find out that we have to share it among X, Y and Z with a condition that the share of profit available to Z will be minimum 1 lakh. It can be more than 1 lakh but cannot be less than 1 lakh. Suppose it is less than 1 lakh. The other partners, namely X and Y, shall have to bear the deficiency in their profit sharing ratio. That is the understanding. Okay? Suppose the net profit for the year is rupees 4 lakhs. That is after Z has joined the firm, 4 lakhs. Now what will be the profit share available to Z? You apply 1 by 5 of 4 lakh, it will be 80,000. But Z is given a minimum guarantee of 1 lakh. Therefore what happened? There is a deficiency of 20,000 rupees. This deficiency should be shared by other partners, namely X and Y, in the ratio of 3:2. So therefore friends, how to calculate the profit share available to the partners? Now, if the total profit is 4 lakh, how much will go to X, how much will go to Y, how much will go to Z? Normally, share of profit. So, Z will get 80,000. The remaining 3,20,000 will be shared by X and Y in the ratio of 3:2. That is 3 by 5 of 320. 64 into 5. That is equal to how much? 64 into 3, the 180 plus 12, 192 will go to X. 192 will go to X. To Y, 2 by 5 of 320, that is 64 into 2, 128. So, the normal share of profit available to XYZ will be 192, 128 and 80 of the total 4 lakhs. But the guarantee given to Z is 1 lakh. Therefore, there is a deficiency of 1 lakh. Deficiency of 20,000. Which deficiency shall be taken from X and Y in the ratio of 3:2. So, what we should do? Deficiency. How much? 20,000. You have to add it to Z. This 20 should be deducted from X and Y in the ratio of 3:2, which will be 12,000 for X and 8,000 for Y. So, it will be minus 12,000 from X and minus 8,000 from Y. Therefore, the correct share of profit will be 180 for X, 120 for Y, 1 lakh for Z. Total profit is 4 lakhs. So, when a partner is given a guarantee of minimum profit, first we should calculate the actual profit share, 4 lakh. In that, X's share will be 192, Y is 128, Z is 80. But you have guaranteed Z minimum of 1 lakh. So, 20,000 should be given to Z from X and Y. So, add 20,000 to Z, deduct from X and Y the 20,000 ratio of 3:2, which is 12,000 for X, 8,000 for Y. So, therefore, X's actual share will be now 1,80,000, Y's will be 1,20,000, 3 lakh plus 1 lakh to Z 4 lakh. This is how the profit will be appropriated or distributed among the partners. Now, let us take another example also to understand how this will be shared by the partners. A, B share profits ratio of 5:4. Okay. C will get 1 by 6. C will get 1 by 6, but minimum guarantee is 40,000. These are the information given in the problem. A and B share profit in the ratio of 5:4. C is given 1/6 share, but the minimum guarantee of 40,000 rupees. Now we have to find out what is the actual profit. Suppose actual profit is 1 lakh or 1,20,000 rupees. Okay. So total profit, suppose it is 1,80,000, not 120, let's take it as 180. Now what will be the share to A, B and C? The share of profit to C will be 180 by 6, that is 30,000. So the remaining 150 will be shared by A and B in the ratio of 5:4. So A's share will be 83,333, that is 5 by 9 of the remaining 150. What will be B's share? 1,50,000 into 4 by 9, that is equal to 66,667. So this is the actual share of profit available to the partners. But according to the problem, C should be given a minimum profit of 40,000. So 10,000 rupees is deficiency. So what we should do? The deficiency of 10,000 should be added to C and deducted from A and B in the ratio of 5:4, that is 5 by 9 of that will be taken by A, 4 by 9 will be taken by B. So what is 5 by 9 of 10,000? It comes to 5,556. So the remaining 4,444 will be taken from B. So this is minus in A and B and plus in the case of C. So what is the actual share of profit? So 83,333 minus 5,556 will be the profit available to A, that is 77,777. For B, 66,667 minus 4,444, that is 62,223, and C's share will now be 40,000. If you add all this, you will get 1,80,000. So check whether the total is 1,80,000. 62,223 plus 77,777 plus 40,000, that is equal to 1,80,000. So friends, this is how you have to adjust the guarantee of minimum profit in favor of the other partners. Sometimes the guarantee may be given by only one partner. Here no information given, therefore what we did, we adjusted the guarantee in both the partners in their profit sharing ratio. But sometimes A only gives the guarantee or B only gives the guarantee. Then what will happen? Very simple. The 10,000 rupees deficiency of C will be taken from A only, like that. Suppose you say A only gives guarantee. If A only gives guarantee, then what will happen? A share is 83,333 minus 10,000. B share is 66,667. He doesn't share anything. C is 30. Add this 10,000. Therefore, what will happen? In the case of A, it will become 73,333. B 66,667 and C will be 40. That is the way you will adjust the profit among the partners. Suppose if B only guarantees, very simple, that 10,000 will be adjusted in B's account. So A's share will be 83,333, B will be 56,667 and C will be 40. So this is how we have to calculate the profit share available to partners when a guarantee of minimum profit is given to the particular partner. Okay, let's go to the next one. Capital ratio. See, normally the partners will share the profit based on the profit sharing ratio as per the agreement. But sometimes the partners may decide to share the profit in the ratio of capital also. Now, if that is given in the problem, calculate the profit for the year, apply the capital ratio. Sometimes the problem would say, calculate the capital ratio depending upon the movement of capital in relation to a particular year. See, if the capital is fixed, no problem. You can always take the same ratio. X is capital 5 lakh, Y is capital 3 lakh. So, capital ratio 5:3, no problem. But suppose, during a particular year, there has been additional capital, there is a drawings of capital, then what will happen? The capital will change, is it not? If the capital changes, how to find the capital ratio and how to share the profit in that proportion we have to see. So let us take an example for that. Okay. X, Y, opening capital 10 lakhs, 6 lakhs. Additional capital introduced 1 lakh on 1st June 20, 80,000 on 1st September 20. Drawings 40,000 on 1st December 20, drawings 20,000 on 1st January 21. Find the capital ratio. That is a question. So how to solve a problem like this? Very simple. Like, how did you calculate the interest on capital using product method? Same principle you should apply to find the sum of the product of X and Y. That will be the basis on which you will share the profits in the future. So let us determine the capital ratio. For X, it will be 10 lakh into 12 because it is there from the opening balance. So that is 12 lakhs. 10 lakh into 12, 120 lakhs. Is it not? 120 lakhs. Then 1 lakh additional capital on 1st June. That means it will be for a period of June to March. How many months? It will be 10 months. That is 10 lakhs. Drawings of 40,000 on 1st February. So minus 40,000 into how many months? Sorry, 1st December, 4 months. So that is minus 4 lakhs. Now what is the effective capital of Mr. X? 120 plus 10 is 130 minus 4, that is equal to 126. So that is 126 lakhs. 1 crore 26 lakhs. That is the effective capital of X. Like that, you calculate effective capital of Y, which is 6 lakh into 12, that is 72 lakhs. Y has introduced 80,000 on 1st September. So 1st September to March will be 7 months, which is 5,60,000. Add. On 1st January he withdrew 20,000, so it is minus 20,000 into 3. That is equal to minus 60,000. So what is the effective capital of Y? It will be 77 lakhs. Is it not? 77 lakhs. Therefore, what is the capital ratio now? It is 126:77. So therefore, you write capital ratio is equal to 126:77. See, if the capital doesn't change, 10 lakh and 6 lakh, no additional capital, no drawing, the ratio is easy. 10:6, that is 5:3, over. But sometimes there will be change in capital, additions and drawings. Then you find the effective capital. Capital multiplied by number of months. You will get the effective capital employed by X, which is 126 lakhs. And in the case of Y, it is 77 lakhs. So therefore, for this year, the profit sharing ratio will be 126:77. So sometimes the partners may agree to share their profits in such ratio also. In that case, we have to calculate in this manner. For that year only, we have to apply this ratio. Next year again, if there is a change in capital, again we have to calculate the next year's capital ratio. So next year's profit will be shared in that proportion. Is it clear, friends? Illustration. Again, let me show you one more problem for calculating the capital ratio. A, opening capital 5 lakhs. Additional capital on 1st July 20, 1 lakh. Again, let us assume additional capital on 1st October 50,000. Drawings on 31st December 20, let it be 20,000 rupees. What is the effective capital of A? We have to find out. Like that, you have to find out the effective capital of other partner also, depending upon opening additions and so on. Is it not? So let us take for B. Opening capital 6 lakhs. Addition on 1st October 20, 2 lakhs. Drawings on 1st November 20, 1 lakh. Again addition on 1st March 21, 50,000. Now what is the effective capital and the capital ratio of the partners? How many months opening capital? 12 months. So calculate that 60 lakhs. Additional capital of 1 lakh from 1st July. That is for a period of 9 months. So 1 lakh into 9, 9 lakhs. Again on 1st October, 50,000 additional capital, that is for a period of 6 months. That is equal to 3 lakhs. 20,000 drawn on 31st December. 3 months are remaining. So that will be how much? It will become minus 60,000. So what is the effective capital? 60 plus 9, 69 plus 3, 72 minus 40 is 60 is 71 lakh 40,000. That is the effective capital of Mr. A. How about B? How many months opening capital? 12 months. That is 72 lakhs. 2 lakhs from October, 6 months. That is 12 lakhs. Drawings of 1 lakh from November, that is for a period of 5 months. So it will become minus 5 lakh. 50,000 addition on 1st March, 1 month 50,000. So find the effective capital, find the total. 72 plus 2, 84. 84 minus 5 is 79. 79 minus 50,000 is 78 lakh 50,000. 78 lakh 50,000 is the effective capital of B. So therefore, what is the capital ratio? The capital ratio will be 714 is to 785 for this year. So this year's profit, if any, will be shared by the partners in the ratio of 714 is to 785. This is how you have to calculate the capital ratio, and only for this year profit this ratio will be applied. Next year the ratio can change. Accordingly you have to calculate it and then share the profits of the business. Now friends, with this let us summarize this chapter. What are the things we learned in this chapter? So many things we learned. Essential features of partnership, difference between normal partnership and LLP, what are the clauses to be shown in a partnership deed, how LLP different from normal partnership, then how to calculate interest and salary. If the salary and interest is not mentioned in the agreement, what we should do, then how to prepare the capital account, 2 different methods, fixed capital, fluctuating capital, how to calculate that, what is the accounting treatment of interest and capital drawings, how to calculate capital ratio, how to prepare the profit and loss appropriation account, then if there is a guarantee of minimum profit, how to adjust the deficiency in other partners. These are the things we have seen in this lesson. Very interesting lesson. Many people think introductory chapter easy, let me not study that. Don't think like that. There is a possibility you may get a 6 marks or 8 marks problem from this lesson itself. Particularly they may ask you to prepare a P&L appropriation account, or they may ask you to prepare the partner's capital account under fixed method and fluctuating method, which is very much possible. So don't ignore. Please learn this lesson carefully. Remember the method of calculating interest on capital drawings, etc. Remember and understand how to prepare the appropriation account and the partner's capital account, and it will be very, very easy. Minimum 6 to 8 marks you may get from this chapter. So friends, with this we come to the end of this lesson, Introduction to Partnership Accounts. Whatever possible, the completely threadbare analysis of this chapter to the extent possible we have done in this class. I hope everything was clear and you will be able to understand it thoroughly, and you get a problem on this. Based on this you will be able to do it in the exam. Of course you will be doing problems on this afterwards also. That will give you more understanding about how to apply what all we learned in this chapter.